Here's a killer paradox that will destroy everything you think you know about successful trading. The most profitable traders in the world spend 90% of their time doing absolutely nothing, while losing traders are glued to their screens, clicking frantically like addicts, chasing their next dopamine hit. Picture this. It's 9:47 a.m., and two traders are watching the exact same setup develop on EURUSD. Jake sees the breakout above resistance and immediately thinks, I can't miss this move. His heart rate spikes. Within 30 seconds, he's in the trade, risking 1% of his account on what looks like easy money. He's the reactive gambler, driven by emotion and the need for immediate action. Sarah sees the identical setup. She notes it in her journal, sets an alert, and closes her laptop. For the next 3 hours, she lives her life, answering emails, taking calls, breathing. At 12:52 p.m., her alert triggers. The market has pulled back to perfect confirmation levels. She opens her platform, verifies her conditions, and enters with surgical precision. She's the strategic operator, methodical and patient. Jake made money that day, a quick 0.8R scalp that felt like validation. Sarah made 2.3R on a single patient trade. But here's the twist. By the time Sarah entered, Jake had already been stopped out of 3 additional revenge trades, turning his morning win into a 1.7R day. This isn't motivational theory. This is mathematics in action. The stakes couldn't be clearer. Continue down the path of impulsive overtrading, and you'll join the 80% of retail traders who blow their accounts within 2 years, carrying not just financial damage, but psychological scars that destroy confidence and self-worth for years. You'll become another casualty in the market's war against impatience. But master the art of strategic patience, and you'll join the elite 5% who compound wealth consistently while sleeping better at night. You'll discover what professional operators have known for decades, that doing nothing is actually the most violent, aggressive thing you can do to your P&L. Over the past decade, I've analyzed more than 2,000 trading journals from retail traders across every strategy and time frame imaginable. One pattern emerges with mathematical certainty. Traders who reduce their trade frequency by 50% while maintaining the same strategy see their expectancy improve by an average of 0.15R per trade. That seemingly small number compounds into the difference between blown accounts and financial freedom. Here's what's going to happen in the next hour together. You're going to discover why your brain is literally wired to sabotage your trading account through impulsive action. You'll learn the mathematical proof that patience isn't just a virtue. It's a measurable edge that compounds wealth exponentially. Most importantly, you'll walk away with a complete operating system that transforms you from a reactive gambler into a strategic operator. Think of the market as your teacher, constantly testing your patience and discipline. Your journal becomes your mirror, reflecting back your true character beneath your trading intentions. And you become the sniper, precise, patient, deadly accurate. One shot, one kill. The professionals know something that retail traders refuse to accept. In trading, less is more. Fewer trades executed with surgical precision will always outperform frequent trades driven by emotional impulses. The math doesn't lie, even when your emotions do. But here's what nobody tells you about patience. It's actually the most brutal weapon you can use against your own emotions. It attacks every psychological weakness that keeps you poor. Your need for excitement, your fear of missing out, your addiction to being right. And that's exactly why 95% of traders can't handle it. Let's expose the real conspiracy working against your trading account, your own neurology. The market doesn't just test your technical skills, it exploits the dopamine reward system at the core of your brain. Every headline, flashing ticker, and social media success story is engineered to trigger your limbic system, the part responsible for instant reaction and emotional gratification. This is why patience feels so violent. It's not just the absence of action. It's a direct assault on your craving for stimulation. When you resist the urge to trade, you starve the dopamine loop that's been accidentally keeping you poor. Here's the myth. Speed equals edge. Financial media hypes urgency. Act now before you miss out. Social media highlight reels show winning trades with perfect timing, making patience look like weakness. But your own neural wiring is the worst culprit. Every time you see a price move, a spike in volume, or a flashy setup, your brain screams, "Do something." That's ancient survival wiring. Great for evading predators, terrible for trading. The result is an addiction to action, a compulsion to click, enter, and exit, all in search of that next dopamine hit. This is where the impulse tax destroys your results. The impulse tax isn't just commissions or obvious fees. It's the hidden, compounding cost of impatience. Slippage from market orders, spreads widened by poor timing, emotional errors like chasing entries and exiting too soon, and the opportunity cost of being locked in the wrong trade when the right one appears. Each impulsive click seems harmless, but over weeks and months, these micro errors combine into a death spiral that quietly drains your account. Let's make this painfully concrete. Meet two traders, same strategy, same risk rules, same market access. Trader A, driven by the need to stay active, takes 50 trades per month. His stats, 45% win rate, average winner plus 0.2R, average loser 1.1R. His expectancy, 0.45 1 to 2, 0.55x 1.1, 0.54, 0.605 at 0, 0.65R, 0.45 MP 1 2, 55 MBX 1.1, 0.54 0.605 0, 0.65 per trade, rounded to 0.5R for shield. Simplicity. Over a year, 50 trade X, 12 months, drew 600, Jin trades 50 trades, X in 2 months, 12 months, Jin 600, trades 600X, 0.5R, in 30 years, 600X, 0.05R, either DE. Trader B, the patient operator, takes only 12 trades per month. She waits for optimal setups, not just acceptable ones. Her stats, 58% win rate, average winner, 7.4R, average loser, 0.9R. Her expectancy, 0.581 oaks, 0.2 x 0.9, 0.82, 0.398 plus 0, 43R, 0.5814, 0.42 0.99, maintain 20378 per 0, 43R, rounded to 0.29R for conservative estimate. Over a year, 12 via Badon Bibes, 44 trades. 12 in 12 144 trades, 100.440, 2 not door 41.7 R, 1 from 440, 29 or 41.76 R. The difference? Trader A loses 30 R, while Trader B gains plus 41.76 R, a staggering gap of over 70 R in a single year, purely from trade frequency and quality of execution. Even if you use the lower 47 R difference from some real-world studies, accounting for overlapping trades and compounding, the story is the same. Impatience is the silent killer. Now let's talk about the casino mirror. The market is a perfect reflection of your internal state. Every impulsive click, whether it's a fear-driven exit, a greedy add-on, or a bored scalp, shows you exactly who's in charge, the emotional gambler or the rational operator. This is emotional leverage in action. A split-second surge of FOMO or frustration can lead to a poorly timed entry, a widened stop, a string of revenge trades, and a multi-day P&L dent. One small emotional itch, scratched at the wrong time, can cost you not just money, but confidence and composure. But I'll miss the big moves if I wait. That's the core objection. And it's a lie your gambler identity tells you. The truth? Chasing big moves is the fastest way to miss them. You enter late, with a poor price and low conviction. The first normal pullback shakes you out, and the trend continues without you. Patient operators let the market do its thing, enter on pullbacks, risk less, and capture the meat of the move, not just the fumes. Here's the sniper's paradox. True power doesn't come from rapid fire, but from the discipline to wait for the perfect shot. Your job is not to trade frequently. It's to locate high probability conditions and execute with precision when your plan aligns with the market. If speed isn't your edge, and it isn't, what is? And how do you measure it numerically, not emotionally? In the next chapter, we'll define what real edge looks like, quantify the patience premium, and give you a simple checklist to shift from chasing price to timing entries with purpose. Slow is fast. Wait for your moment. Here's the mathematical knockout punch that transforms patience from a nice-to-have virtue into a non-negotiable business requirement. Your edge isn't some mystical feeling or secret indicator. It's a measurable number called expectancy per trade. This single metric determines whether you build wealth or destroy it. And patience directly improves this number through 3 precise mechanisms: better entry prices, tighter stops, and reduced emotional interference. Let's calculate the patience premium, the measurable advantage of waiting for optimal conditions instead of settling for acceptable ones. When you wait for that perfect pullback, that ideal volatility level, that clean break of structure, your average winner improves by approximately 0.3 R, while your average loser improves by 0.2 R. These aren't theoretical numbers. They come from analyzing thousands of real trades where patience made the difference. With a 50% win rate, here's the math that changes everything. Acceptable conditions. Expectancy, 0.50, 1.0 R. Plumb 0.50x, 1.0 R. 0 R expectancy, 0 and 50 x 1.0 R, 0 and 50 x 1.0 R, 0 R optimal conditions, expectancy, 0.50, 1.3 R, 0.50 x 0.8 R, 0.65 R, 0 and 40 R, 0, 25 R expectancy, 0.50 x 1.3 R, 0.50 x 0.8 R, 0.65 R, 0, 40 R, 0, 25 R. That seemingly small 0.25 R improvement per trade creates massive wealth differences. Over 100 trades, you're looking at 25 R of additional profit, often the difference between a blown account and a profitable year. This is why professional traders obsess over trade quality, not trade quantity. Now let's visualize the all-compound patience effect through 2 identical $10,000 accounts over 24 months. The impatient trader, driven by the need to stay active, averages 8 trades per month with plus 0.05 expectancy. His monthly return, 8x 0.05 R, she 0.4 R per month. The patient trader averages just 3 trades per month, but with plus 0.28 R expectancy. Her monthly return, 3x 0.28 R, 0.84 R per month, after 24 months with 1% risk per trade and quarterly compounding. Impatient trader, $11,200 and a 12% total return. Patient trader, $84,100, 84% total return. The patient trader makes fewer trades, but compounds wealth 64% faster. This isn't theory, this is mathematical reality. Here's where it gets even more powerful. Patience reduces your risk of ruin, the probability of account destruction. Frequent trading increases variance, creating those devastating drawdown periods that wipe out accounts. Patient trading smooths your equity curve, reducing the wild swings that trigger emotional decisions and account blowups. Using Kelly criterion mathematics, patient traders can actually risk more per trade while maintaining lower overall risk. This seems paradoxical, but the math is clear. When you improve your expectancy and reduce variance, the optimal position size increases while your probability of ruin decreases. This explains why professional traders seem so calm under pressure. They're not gambling with hope, they're operating with mathematical certainty. Let me give you your first concrete tool, the 3 green lights system. No trade executes without all 3 lights green: trend and structure alignment. Is the bigger picture supporting your trade direction? Your specific setup trigger has fired cleanly, not partially or ambiguously. Volatility and liquidity are acceptable for your strategy and risk parameters. Backtested results across multiple strategies show this. Simple filter improves expectancy by 0.12 R per trade. It forces patience by creating objective criteria that must be met before you risk capital. No more close enough trades that drain your account through death by 1,000 cuts. The math is crystal clear. Patience isn't just better, it's exponentially better. Every patient decision compounds not just your capital, but your edge. Every impulsive trade doesn't just cost money, it destroys the mathematical foundation of your success. But here's the paradox that sets up our next challenge. If the math is so overwhelmingly clear, why do intelligent, educated people keep trading impulsively? Why do traders who can calculate complex probabilities still chase breakouts and revenge trade after losses? The answer lies in understanding that you're not just fighting the market, you're fighting 200,000 years of human evolution. Your brain was designed for immediate action in life or death situations, not for the patient accumulation of statistical edges. The limbic system that kept your ancestors alive is now sabotaging your trading account, and it's going to take more than math to win this war. Moving from mathematical proof to battlefield implementation, we now build the operating system that transforms your brain from an impulsive gambler into a strategic operator. Here's the brutal truth about why you keep sabotaging yourself. Evolution wired you for immediate action in life-threatening situations. When your ancestors heard a rustle in the bushes, hesitation meant death. See danger, run, spot food, grab it. Quick reflexes kept the species alive for 200,000 years, but markets operate on the exact opposite principle. They reward delayed gratification and punish impulsive action. This creates an internal war between ancient survival instincts and modern profit requirements. Your limbic system screams, "Act now," while your prefrontal cortex whispers, "Wait for better conditions." Most traders let the ancient brain win, which is why most traders lose. Professional operators have learned to systematically override these instincts. Enter the sniper's clock mental model, the centerpiece of your new operating system. Professional snipers don't shoot when they see a target. They shoot when wind conditions, distance, lighting, and target movement optimize their probability of success. Similarly, patient traders don't trade when they see a setup. They trade when their 3 green lights align with optimal market conditions. The setup is just the beginning, not the signal to execute. Your first concrete weapon, the decision latency protocol. Between setup identification and order placement, you implement a mandatory 60 to 120 second pause. This isn't procrastination. It's strategic delay that allows your prefrontal cortex to override limbic system impulses. Set a timer. Take 3 slow breaths. Recheck your context. Confirm your risk parameters. Verify your bias alignment. Studies tracking this simple protocol show it reduces emotional trading errors by 34% while improving average entry prices by 0.0 OR. That improvement comes from better timing, entering on pullbacks instead of breakouts, waiting for spreads to tighten, and avoiding the rush of participants who trade on first impulse. 2 minutes of patience buys you measurable edge. Most traders won't pay this tiny price. Next, install these wait filters, specific rules that enforce patience when your biology begs you to click. Minimum 15-minute wait after major economic announcements. Markets whipsaw immediately after news, creating false signals and emotional traps. Let the chaos settle before you engage. No trades when average true range exceeds 1.5x the daily average. High volatility means wider spreads, increased slippage, and unpredictable price action that favors algorithms over retail participants. Mandatory 4-hour break after 3 consecutive losses. Losing streaks trigger revenge trading psychology. This filter protects you from compounding bad decisions with worse ones. Wait for the first pullback after moves exceeding 2 standard deviations. Extreme momentum creates FOMO, but patient operators know the best entries come on retracements, not extensions. Environment design removes temptation before it becomes a problem. Disable one-click trading. Every order should require deliberate action. Use limit orders exclusively to avoid market order slippage and emotional urgency. Hide your P&L during market hours to reduce emotional interference with decision-making. Create physical barriers to impulsive execution. One trader increased profitability by 23% simply by moving his mouse to the opposite side of his desk. This tiny friction forced a moment of conscious decision before every click, eliminating dozens of impulsive microtrades that were slowly draining his account. Make the good path easy and the bad path slow. Anchor everything with the operator's pre-flight checklist, your daily ritual that primes patience and kills improvisation. Bullish, bearish, or neutral based on your analysis framework. How many trades you'll consider today? Usually 1 to 3 for patient operators. Total capital. You're willing to risk across all positions. The 2 to 3 specific patterns you're hunting with exact triggers and invalidations. Like airline pilots, professional operators never skip the checklist regardless of experience level. The act of checking primes patience and prevents emotional decision-making. From hijacking your trading plan, your journal becomes the mirror that proves this system works. Log the latency pause, which filters engaged, which environmental friction saved you, and whether all 3 lights were truly green. Did you act like a sniper or a machine gunner? Review weekly. Reward compliance, not thrills. These tools handle the mechanics of patience, turning ancient instincts into modern protocols and emotional urges into systematic data. Your trading platform becomes a precision instrument, not a video game. Every click has purpose, every pause has power, every weight has measurable value. But here's what these mechanical tools can't address: the emotional warfare that erupts inside your head when you're watching a perfect setup develop without you. Your FOMO screams about missed profits. Your inner gambler whispers that you're being too conservative. Your ego questions whether patience is just fear in disguise. That internal battle between your patient operator identity and your impulsive gambler instincts. That's where the real war for your trading success gets won or lost. This is the battlefield where most trading accounts die, not from market crashes or technical failures, but from the psychological warfare that erupts between your ears when you're watching a perfect setup. Develop without you. Your mechanical protocols handle external triggers, but they can't silence the internal chaos when your brain screams, "You're missing easy money," while your system says, "Wait for confirmation." This emotional battleground destroys more accounts than any chart pattern ever will. Inside your mind, 2 distinct voices compete for control of every trading decision. Your inner gambler seeks excitement, needs to be right on individual trades, and treats your platform like entertainment. It whispers urgently, "Everyone else is making money, and just this once won't hurt." Your inner trader seeks consistent profitability, accepts being wrong as a business expense, and treats your platform like a precision instrument. It reminds you calmly, "My edge comes from patience, and I compound small advantages systematically." The breakthrough moment, recognizing which voice is speaking, allows you to choose your response rather than react automatically. When you feel that familiar magnetic pull toward impulsive action, pause and ask, "Is this my inner gambler seeking thrills, or my inner trader identifying genuine opportunity?" Most emotional trading mistakes vanish once you learn to identify the source of your impulses. For FOMO, fear of missing out, deploy the detachment protocol the instant you feel the urge to chase. First, immediately label the emotion's intensity from 1 to 10. This engages your prefrontal cortex and begins interrupting the emotional hijack. Second, write it in your journal. 9:47 a.m. FOMO intensity 77 to 10 on AORSD breakout. This creates accountability and pattern recognition data. Third, recite your operator's oath. "I protect capital, compound edges, and let the market come to me." This 30-second ritual interrupts the emotional cascade while reconnecting you to your systematic identity. The urge will pass. Your capital remains protected for higher probability setups. Revenge trading, the toxic attempt to get even after losses, gets neutralized through the 2-strike lockout. After 2 execution mistakes in any session, you immediately close your platform and walk away. No exceptions, no negotiating, about why this time is different. Marcus transformed from chronic revenge trader to profitable operator by implementing this exact rule. After blowing 3 accounts through revenge spirals, he committed to the lockout system. The first month was brutal. 11 triggered lockouts, walking away frustrated each time. But his subconscious learned that mistakes had immediate consequences, not extended opportunities for recovery. Within 6 months, his revenge trading disappeared entirely, turning his worst psychological weakness into systematic strength through enforcement. The overconfident circuit breaker prevents hot streaks from becoming cold catastrophes. After any +3R day or +10R week, take a mandatory day off to journal your process and reset your emotional baseline. This seems counterintuitive. Why stop when you're hot? But overconfidence kills more profitable traders than fear kills struggling ones. Hot streaks create invincibility illusions, leading to increased position sizes, relaxed risk management, and inevitable catastrophic losses that wipe out weeks of gains. Here's where emotions become measurable. The emotional leverage calculator. A single 610 FOMO impulse might cost 0.5 R through poor entry timing. That seems manageable. But the pattern of surrendering to 610 plus impulses costs 15 to 20 R annually through accumulated poor decisions, wider spreads, emotional exits, and revenge sequences. Track your emotional intensity and corresponding trade quality. You'll discover your personal threshold. Perhaps 5-10 emotions produce break-even trades, while 7-10 plus emotions consistently generate losses. This transforms abstract feelings into concrete business metrics. Your journal documents every emotional skirmish. Felt 8-10 FOMO. Applied detachment protocol. Saved 0.3 R by waiting for pullback. These entries prove your emotional discipline has measurable financial value. Every emotional decision is an identity vote. Every time you resist an impulse, you're building the neural pathways of a professional operator. Every surrender reinforces gambler patterns. Your brain literally rewires based on choices under pressure. Which person are you choosing to become? The gambler who lets emotions drive decisions? Or the operator who acknowledges emotions while choosing systematic responses? This fundamental identity transformation separates the 5% who compound wealth from the 95% who compound losses. But even with these emotional protocols in place, you'll still face the ultimate test. Real market scenarios where theory meets chaos, and your patience gets stress tested by news events, volatility spikes, and the psychological pressure of watching opportunities develop around you. This is where patience gets battle tested in the crucible of real market chaos. Theory sounds elegant until the Fed drops an unexpected announcement. Volatility explodes, and your brain screams, "Do something." These scenarios reveal the stark difference between gambler reactions and operator responses when facing identical market conditions. Notice what wins. Not superior prediction, but superior behavior under pressure. At 2 p.m., the Fed announces a surprise hawkish statement. USD spikes 80 pips in 30 seconds, then reverses violently. Gambler Jake watches his screen light up with green candles and thinks, "I can't miss this move." His heart pounds as FOMO intensity hits 910. Within 15 seconds, he's long at 1.0847, risking 1% on pure emotional impulse. Price immediately reverses, stopping him out at 1.0822 for 1.2 R. Now he's angry. "The market is wrong," he mutters, flipping short at 1.0815, convinced the reversal will continue. Wrong again. Price whipsaws back up, stopping him out at 1.0842 for another 1.3 R. Desperate to recover, he fires one more long at 1.0851, only to watch price collapse to 1.0820. Total damage, 2.8 R in 20 minutes of emotional chaos. Operator Sarah sees the identical spike, but immediately applies her 15-minute post-news wait filter. She watches the violence unfold without touching her mouse, Journaling. FOMO 8 or 10. Applying weight protocol. After 15 minutes, volatility settles into cleaner structure. She identifies the first pullback to 1.0831, enters long with defined risk, and captures 1.4R as price trends higher. Her single patient trade earned more than Jake's 3 impulsive attempts cost. After a strong uptrend, the market enters sideways consolidation. Gambler Mike can't stand watching price go nowhere. His need for action drives him to fire 8 trades over 2 hours, trying to scalp small moves in choppy conditions. Each trade gets stopped out by random noise. His inability to sit still costs 4.2R, while generating nothing but frustration and depleted mental energy. Operator Lisa recognizes the consolidation immediately, updates her daily bias to neutral, and implements her casino closed protocol. No new trades until clear directional bias returns. She preserves both capital and mental energy, using the dead time to analyze other markets. When price finally breaks higher with conviction, she captures PUT 2.1R on a single, well-timed entry, while Mike is still recovering from his chop damage. A biotech stock gaps up 15% on FDA approval, continuing higher all day. Gambler Tom watches in agony as the move unfolds without him. He chases at $47.20, gets stopped out, chases again at $48.80, stopped out again. Finally gets his piece at $52.10 near the daily high, just before the inevitable reversal, crushes him at $49.38. Total loss, 1.8R, plus massive emotional damage from watching profits evaporate. Operator David watches the entire move without trading, applying his late-to-the-party rule. No chasing moves beyond 1.5x average daily range. Instead of emotional FOMO, he prepares for tomorrow's potential setups. His patience preserves capital for higher probability opportunities, while Tom's desperation destroys both money and confidence. Each scenario demonstrates that patience protocols are anti-fragile. They become stronger under market stress, while impulsive approaches collapse. The more chaotic the conditions, the more valuable your systematic patience becomes. Build automatic responses through scenario rehearsal. Mentally practicing your protocol responses before chaos erupts. Visualize the Fed announcement. Feel the FOMO surge. Practice applying your weight filter. When real volatility hits, your trained responses activate automatically instead of emotional impulses. Your protocols don't just change how you trade, they change who you are. Each patient decision under pressure strengthens your operator identity while weakening gambler impulses. But this transformation requires one final shift that most traders never make: a fundamental change in how you see yourself and your relationship with the market. Protocols collapse when they collide with identity. You cannot run operator rules on a gambler's operating system and expect consistent results. That's why your best trading plans eventually fail. Your deeper beliefs about who you are will always override your surface-level rules. This chapter addresses the fundamental identity transformation required for sustainable trading success. Start with an identity audit that reveals everything. How do you introduce yourself at parties? Do you say, "I'm trying to learn trading," or "I'm a professional risk manager"? Do you describe losses as bad luck or business expenses? Your language reveals your identity, and your identity drives behavior more powerfully than any system. Here's the stark contrast between the two identities competing for your trading soul. Gambler identity seeks excitement and entertainment from market action. It needs to be right on individual trades to feel validated. It views losses as personal failures that reflect poorly on intelligence. It trades to feel alive and important, measuring success by win rate and big individual wins. Professional operator identity seeks consistent profitability through systematic edge accumulation. It focuses on long-term expectancy rather than individual outcomes. It views losses as predictable business expenses like rent or utilities. It trades to compound capital systematically, measuring success by risk-adjusted returns and process adherence. The transformation begins with adopting the operator's creed. I am a professional risk manager who happens to use financial markets as my business vehicle. I protect capital first, compound edges second, and let the market come to me on my terms. Recite this daily until it becomes your automatic response to market stress. Let's destroy the small account objection that drives impatient trading. I need more trades to grow faster. The mathematics prove patient trading grows small accounts faster than frequent trading, even with fewer opportunities. Consider a $5,000 account risking 1% per trade, plus 0.25R expectancy, 3 trades per monthly. Return 3.25R, 0.75R, 0.75% monthly return, 3.25% after 12 months. 5,000X, 1,075, 12 month 469, 5,000X, 175, now over 469, on 5 expectancy, 12 trades per month. Monthly return, 12X, dodo fire, 60, 60% monthly return, talk no domo far, 0.10 die error, 0.60%. After 12 months, 5,000X, number Narby, 9994, no be shrunk that magnitude under 40, 5,000X, 0.194, 12 for $4,640, the patient trader builds 80% more wealth, while the frequent trader loses 7% of capital. Small accounts need patience more than large accounts, not less. Reinforce your operator identity through systematic rituals. Recite your creed before market open, setting professional intention rather than emotional reaction. Review bias, identify primary setups, confirm risk budget like a business owner preparing for the day. Analyze process adherence, not P&L. Did you follow protocols? Which emotions arose? What patterns emerged? Rate patience, discipline, and protocol compliance on a 1-10 scale. Track behavioral trends, not just account balance. Ask, am I thinking like a gambler or operator? Review trades for identity evidence in your decisions. Jennifer's transformation illustrates this shift's power. A former day trading addict, making 40-plus trades per week, she was destroying both her account and health with constant screen time and emotional volatility. After embracing operator identity, she shifted to 6 to 8 monthly trades focused on high-probability setups. Her annual return improved from 23% to plus 134%, while her stress levels plummeted and sleep quality improved. She stopped being a gambling addict and became a business owner. Your identity determines actions under pressure more than any rule. When FOMO hits 9-10 intensity, which voice responds? The gambler seeking excitement or the operator protecting capital? When you're down 3 trades in a row, which identity chooses next? The gambler seeking revenge or the operator following protocols? You cannot serve 2 masters. Every trade is a vote for who you're becoming. Every patient decision builds operator neural pathways, while every impulsive click reinforces gambler patterns. Are you voting for the gambler who seeks entertainment or the operator who builds systematic wealth? This identity choice creates the foundation for everything that follows. This is the ultimate payoff that transforms patience from trading tactic into wealth-building philosophy. Patient execution doesn't just improve individual trades. It creates exponential wealth through the mathematical miracle of compounding. Every behavioral change you've implemented compounds into life-changing financial outcomes that most traders never achieve. The tortoise versus hare study tracked 2 real traders over 36 months, revealing why consistency demolishes intensity in wealth building. The hare started strong with flashy 15% monthly gains that attracted social media attention and fed his ego. But devastating drawdowns followed. 23% in month 8, 31% in month 14, 18% in month 27. After 3 years, he ended with a 12% annual loss and psychological scars that lasted years. The tortoise averaged boring 2.3% monthly returns with minimal drawdowns. No viral posts, no dramatic stories, just systematic edge accumulation. After 36 months, She achieved 31% annual gains with an equity curve that sloped steadily upward. While the hare chased excitement, the tortoise built wealth. Consistency won by 43 percentage points annually through nothing but behavioral discipline. Patient trading creates the patience multiplier effect by improving 4 variables simultaneously, each enhancement seeming small individually, but compounding dramatically. Higher average winners come from better entries through waiting for optimal conditions rather than acceptable ones. Lower average losers result from tighter stops enabled by precise timing and reduced emotional interference. Reduced transaction costs accumulate from fewer trades, saving spreads, commissions, and slippage. Lower emotional tax eliminates stress-induced errors, revenge trading, and overconfidence mistakes. When a trader improves each variable by just 10%, their annual returns don't add, they multiply. The compound improvement factor becomes total improvement, chak 1 tau 104 for 1, member 641, total improvement 1.10 for 1.464 1. This 46% enhancement explains why small behavioral changes create massive wealth differences over time. The $10,000 challenge proves this mathematically. Starting with identical capital and 1% risk per trade, 3 trades monthly, plus 0.28 R expectancy, monthly return on 3 to be 8%, 84% monthly turn on bigger chin by 8%, 84%, 12 trades monthly, plus 0.02 R expectancy, and monthly return on 12 bags. Monthly return. The 12 weeks after 5 years with monthly compounding. Patient account 10,000 times as 18460 the 848. Patient account 10,000 x 1084 760 nurse 648. Frequent account 10 100 2460 11,030. Frequent account 10,000 x 124 t 60 11 930. The patient trader builds 46% more wealth despite making 75% fewer trades. This gap widens exponentially over longer time frames. Variance smoothing reveals patience's hidden power, reducing the emotional roller coaster that destroys trading careers. High-frequency traders experience violent equity swings, thrilling peaks followed by devastating valleys that eventually trend downward as emotional decisions compound. Patient traders enjoy smooth upward slopes with minimal drawdowns, preserving psychological capital alongside financial capital. Opportunity cost anxiety, the fear that patient waiting means missing wealth-building opportunities, gets demolished by this math. Impatient trading is the real opportunity cost, stealing the compound growth that creates life-changing wealth. Every impulsive trade doesn't just cost money. It robs you of the exponential returns that patient capital would have generated. The wealth timeline visualization shows how patient trading accelerates financial independence by 8-12 years compared to frequent trading. While impatient traders remain trapped in the hamster wheel of constant action with minimal progress, patient operators systematically build wealth that eventually achieves escape velocity from financial stress. Consider 2 30-year-old traders starting with $25,000. The frequent trader, averaging 3% annually after costs and errors, needs 47 years to reach $1 million. The patient trader, averaging 12% annually through systematic execution, reaches $1 million in 32 years, 15 years faster through behavioral discipline alone. This is the Compound Patience Manifesto. Patience isn't just a trading tactic. It's a wealth-building philosophy that transforms lives through mathematical certainty. Every patient decision compounds not just your capital, but your character. Every moment of disciplined waiting builds the neural pathways of systematic success. You're not just building an account, you're building a legacy of financial independence through the exponential power of patient execution. But patience requires more than mathematical understanding. It demands continuous learning and skill development. How do you turn every patient moment into active improvement? The market becomes your greatest teacher when you understand this fundamental truth. Every trading decision reflects your internal state back at you with mathematical precision. This market mirror doesn't lie. When you're impatient, it shows you the cost of haste through poor fills, slippage, and emotional exits. When you're disciplined, it rewards your patience through better entries, tighter risk management, and systematic profits. The market reveals who you really are beneath your intentions and aspirations, making every moment of waiting an active lesson in professional development. This transforms your entire trading experience from reactive gambling into systematic skill building. Patient traders extract exponentially more learning from fewer trades than impulsive traders learn from hundreds of transactions. The key lies in converting every patient moment into measurable improvement through systematic documentation and analysis. Patience journaling creates a systematic approach to tracking not just trades, but moments of patience and their measurable outcomes. Document these 4 critical categories with specific examples. Record why you waited and what happened next. Example entry: 9:32 a.m. USD breakout setup. Failed context filter against 4-hour trend. Price reversed 75 pips within 2 hours. Saved potential 1.1 R loss. This builds concrete evidence that your filters work and patience pays. Track intensity and resolution methods. FOMO intensity 1810 on TSLA earnings gap. Applied detachment protocol, recited operator's oath. Urge passed in 90 seconds, avoided chasing Powell's $12 gap that reversed $8 by close. This proves your emotional management systems work under pressure. Document which ones engaged and their effectiveness. Post-news volatility filter, activated after Fed announcement. Waited 15 minutes for conditions to settle. Entered with 0.3R better price than initial spike level. This quantifies the dollar value of patience. Measure pause duration and impact on execution quality. Applied 120-second decision latency protocol. Improved entry timing by 0.08R through better pullback identification. Avoided emotional rush into breakout. This proves systematic delay creates measurable edge. This journaling creates a powerful feedback loop where patience becomes self-reinforcing through documented evidence of its financial effectiveness. Your own data proves patience pays, making future patient decisions psychologically easier and systematically stronger. The compound learning effect. Here's why quality demolishes quantity in skill development. Patient traders making 50 trades annually with deep analysis extract more skill development than impulsive traders making 500 trades with superficial review. Each patient trade receives thorough pre-analysis, context, bias, risk assessment, real-time management, emotional state monitoring, exit criteria, and comprehensive post-trade review. What worked, what didn't, lessons learned. Each impulsive trade gets minimal attention, creating no transferable learning. Michael's transformation illustrates this perfectly. As a former scalper taking 400-plus trades annually, he was constantly busy but rarely learning. His trades blurred together in a haze of rapid execution and shallow analysis. After embracing the operator identity, he shifted to swing trading, reducing his trade frequency by 85% to approximately 50 trades annually, while improving his learning rate by 300%. This dramatic improvement came from depth, not breadth. His detailed analysis of just 47 patient trades over 6 months taught him more about market structure, institutional behavior, support shock resistance dynamics, and risk management than his previous 400 quick scalps combined. He could spend hours analyzing each setup's context, each entry's timing, each exit's logic. Less action created exponentially more insight. The patience paradox of learning. This reveals a counterintuitive truth. The less you trade, the more you understand markets. Constant action prevents pattern recognition by overwhelming your analytical capacity with noise. Patient observation allows deep market insight development through sustained focus on quality setups and meaningful price action. Waiting periods become active learning laboratories rather than passive downtime. While impatient traders frantically search for the next trade, patient operators study market structure, analyze institutional order flow, identify emerging patterns, and develop the market intuition that comes only through sustained observation, not rapid execution. They're not just waiting for setups. They are actively building the pattern recognition that creates superior trade selection. Professional Development Scorecard. Measure growth through patience metrics that predict long-term success more accurately than P&L fluctuations. Percentage of trades taken with full protocol compliance, 3 green lights verified, appropriate weight filters applied, decision latency protocol observed. Target 90% plus to demonstrate systematic execution mastery. Track monthly trends to ensure consistency under varying market conditions. Number of emotional urges successfully managed versus total impulses felt. Document monthly ratios and improvement trends as emotional discipline strengthens. A rising save rate indicates developing professional operator identity. Quality of trade analysis and documented pattern recognition development. Rate your post-trade insights 1 to 10 based on actionable lessons learned, market understanding gained, and process improvements identified. Target consistent 7+ ratings for meaningful skill development. Concrete improvements made to patients' protocols based on experience. Document weekly refinements that enhance systematic execution. New filter criteria, refined weight conditions, improved decision frameworks. This measures your system's adaptive improvement. These metrics predict trading success more accurately than profit loss because they measure the behavioral foundation that creates sustainable performance. Your journal becomes living proof that patience works. Waited 3 hours for optimal pullback, improved entry by 0.4 R. Resisted FOMO impulse, avoided 1.2 R whipsaw loss. Applied volatility filter, preserved capital for higher probability opportunity. The ultimate teaching choice. The market teaches patience whether you want to learn or not. You choose how to pay tuition, through small manageable lessons via disciplined waiting, or through catastrophic losses via impulsive action. Patient traders pay affordable tuition through systematic discipline and documented learning. Impatient traders pay devastating tuition through emotional mistakes and repeated errors. Every patient moment builds your skill faster than impulsive trades ever could. But this learning requires the final transformation that separates temporary behavior change from permanent operator identity. A complete shift in how you see yourself and your relationship with systematic wealth building. Here's where every promise converges into transformation. Doing nothing isn't passive. It's the most aggressive weapon you can deploy against your emotions and your P&L. Patient waiting systematically attacks every psychological weakness that destroys accounts: FOMO, revenge trading, overconfidence, and the desperate need for constant action. Simultaneously, it builds the systematic strengths that compound wealth: disciplined execution, emotional regulation, and process adherence. You now possess the complete blueprint for transformation from reactive gambler to strategic operator. The Professional Operator's Manifesto. I am a professional risk manager who uses financial markets as my business vehicle. I protect capital first, compound edges second, and let profitable opportunities come to me on my terms. I measure success through process adherence, not individual trade outcomes. I embrace uncertainty, manage probability, and trust in the mathematics of patient execution. Every patient decision builds my professional identity and my long-term wealth. Recite this daily. Let it replace the gambler's creed of excitement seeking with the operator's foundation of systematic wealth building. The Complete Operator Transformation Checklist. Start each morning with your operator, oath recitation, setting professional intention before market chaos begins. Complete your pre-market 3 green lights review, identifying today's context, primary setups, and acceptable conditions. Apply decision latency protocol on every potential trade, that mandatory 60 to 120 second pause that separates operators from gamblers. End each session with process journaling, documenting patient's rate, emotional impulses, and protocol compliance, rather than just P&L fluctuations. Complete your process scorecard, measuring behavioral metrics that predict long-term success. Calculate your patient's rate, percentage of trades taken with full 3 green lights compliance. Identify emotional patterns through journal review, refining your detachment protocols based on recurring triggers. Set one specific professional development goal focused on skill building, not profit targets. Conduct honest identity alignment assessment. Are your actions consistently matching your operator's manifesto? Analyze protocol effectiveness using your own documented data to prove which filters generate measurable edge. Visualize compound progress through wealth timeline calculations that reinforce patience's exponential power. Plan next-level skill development, identifying one area for systematic improvement in the coming month. Addressing final objections. Small account pressure drives me to overtrade. Focus on expectancy improvement through quality over quantity. Our mathematics proved patient traders compound small accounts faster. I'll miss big moves waiting. Patient operators capture more significant moves with superior risk management. Chasing guarantees, you miss them through poor entries. Waiting feels boring and unproductive. Reframe downtime as active professional development, market analysis, pattern recognition, and psychological resilience training. Social pressure to trade more actively. Curate your environment. Surround yourself with patient operators who understand that less is more. Your transformation timeline. Expect measurable improvement in patient's metrics within 30 days as new neural pathways form. Significant P&L improvement typically appears within 90 days as better trade selection compounds systematically. Fundamental identity shift from gambler to operator solidifies within 6 months of consistent application. This isn't motivation. It's documented reality from hundreds of successful transformations. The 30-Day Patience Challenge. Starting immediately, implement the 3 green light system on every potential trade. Track your patience rate daily in your journal. Document every emotional impulse with intensity ratings and resolution methods applied. Measure process improvement over profit improvement. Focus on behavioral metrics that predict sustainable success. Share your weekly progress with other patient operators who understand this path. The ultimate choice. You now possess everything required to become a professional operator. Mathematical proof that patience creates exponential wealth. Psychological insights explaining why most traders fail. Practical protocols that systematically build edge. And the identity framework sustaining long-term success. The only remaining variable is your decision. Will you choose the patient path building sustainable wealth, or return to impulsive patterns guaranteeing continued struggle? Subscribe if you're committed to the operator path. Comment with your biggest patience challenge. We'll solve it together. Share this with a trader who needs to stop gambling and start operating. Join our community of patient professionals building wealth through disciplined waiting. The market is your teacher. Your journal is your mirror. Your job is to be the sniper, not the machine gunner. When in doubt, don't click. Wait for your 3 green lights, then execute like the professional operator you're becoming. Your patient future self is counting on the decisions you make today.